unfortunately, just a few days ago, the stock market had one of its worst days since COVID. And a lot of folks are wondering, is this what we've been worried about? Is this the beginning of the end? Should I get out? And so in today's video, I want to share with you my views in very simple terms. What are the four main things that cause the stock market to go down? And more importantly, what you can do to protect yourselves. Okay, let's go for a little walk and let's talk about this. And the first thing has a technical sound to it, but it's super easy to explain. It's called the Japanese carry trade. And so what the heck is that? The Japanese carry trade, and it doesn't just happen in Japan, it happens all over the world. The carry trade is essentially when you can borrow money one place inexpensively, and then you can invest it in a loan somewhere else and make more money. So let me give you a simple example. Let's say you have a friend, Jack, and you can borrow money from Jack at 2%. And then you have an uncle who needs to borrow money from you. You can lend him that money that you just borrowed from Jack. You can lend it to your uncle. Let's call the uncle Uncle Sam. You can lend it to your Uncle Sam at 4%. So you're borrowing from Jack at 2% and you're loaning it out to Uncle Sam at 4%. So that's all it is. It's super easy. And the reason that trade started to unwind is severalfold, but mainly because interest rates in Japan are starting to go up. So it's no longer profitable to do that, or it's not as profitable. So that's the first one. The second one is we're all listening to what the Federal Reserve is doing. They control the interest rates in the United States. The Federal Reserve recently had a meeting and they decided to keep rates unchanged. Many people were hoping for a rate cut. As I record this, many people are expecting the next Federal Reserve meeting for there to be a rate cut, but so far there has not been one. And so people are worried that perhaps the Fed is taking too long to lower rates. And unfortunately, time in history is not on the Federal Reserve side. The Federal Open Markets Committee is what I should be saying, Jerome Powell. Time in history is not on Jerome Powell's side when it comes to doing a soft landing, which we're all wishing Jerome Powell the best because we all want a soft landing. None of us want to have a hard landing. Certainly none of us want a recession. And if there is going to be a recession, we want it to be as mild as possible. And so there's concern that perhaps the Fed is waiting too long. And one of the things that drove that concern is the recently released unemployment numbers that show unemployment starting to climb. And there's a rule in my industry, it's called the SAM rule, that shows anytime unemployment goes from its low point and it increases by a 0.5 percentage point, that every time that's happened, there's been a recession. Around that time. Actually, it's not a leading indicator. It's something that kind of says that you're already in a recession, whether it's been defined that way or not. So that's the second reason. The third reason, frankly, is the stock market is up a lot. In the 9 months leading up to the end of July, the stock market was up 32%. That's a huge move. And the stock market was not inexpensive when it began that move. And so what drove that move? You know, there's everybody has their own opinion. It's really the Magnificent Seven were the drivers of that. The Magnificent Seven are just 7 tech companies, Google, Facebook, I'm sorry, I should be saying Alphabet, Meta, Apple Computers, Amazon, Microsoft, and NVIDIA. And these are all companies that people are anticipating are going to benefit handsomely from the artificial intelligence, those drives. And you know what? Artificial intelligence has the capability and the possibility of really reducing costs for companies, right? Companies are trying to do things better, faster, cheaper, and as investors, those are good things for us. But as an employee, that's not necessarily a good thing, right? We all know in our lifetimes, many of us have been working 20, 30, 40 years. The pace of everything is increasing, and the intensity and the pressure just continues to increase. And with artificial intelligence now, I think that's going to increase. And then on top of that, many people are looking and saying, do I have to worry about my job, right? So the third cause of why the stock market was down recently, I think, was just it's had such a big run. And there's a saying, trees don't grow to the moon, no matter how beautiful the trees are. So it's natural, and frankly, it's probably healthy for there to be pauses along the way, on the way up, so that we don't have a bubble being created, so that we don't have a sudden burst like we did with the dot-com bubble. Okay, the other thing, right now there's a lot of uncertainty, both at home with the US presidential election. This is not a political channel, but there is uncertainty as to which way the election is going to go. And then geopolitically, there's been a lot of geopolitical tension, certainly more in the last 2 years than there had been in the 2 years prior to that. And in the at least decade leading up to that, we really had a relative, not completely, but a relatively peaceful time. And now just about every country is increasing their spending on defense and unfortunately also offensive capabilities. So military spending, defensive spending is going up. And so that's part of what's driving this, is just the geopolitical tension. Could there be a global conflict? We all hope and pray not. But the chances of that are certainly higher today than they were 5 years ago. So it's the geopolitical. And then, you know, there's another factor that I want to share with all of this, and that is nobody knows for sure why the market, you know, everything was going fine and dandy this year until just recently, and then the stock market had that big correction. What was special about that day? There's really nothing that jumps out at me as one thing, more of these tea leaves coming together, and that's often what happens in the stock market. Everything's okay until it's not. You saw that with the dot-com bubble. I mean, people were predicting the dot-com bubble burst for 2 or 3 years, maybe even more than that, longer than that, before it actually happened. And everything was working until it wasn't. And then all of a sudden there's this coalescing impact, and I think that's part of what happened. So what should you do? More importantly, what should you do? You know, hopefully you've got the right asset allocation, you've got the right amount of stocks and bonds in your portfolio so that you can withstand a downturn. Trying to time the market is really dangerous. We've all heard, if you miss out on the 10 biggest days in the stock market, instead of beating inflation, you might just keep up with inflation or actually trail inflation. So timing the market is really challenging. So what should you do? You should get your asset allocation right. And if you feel like, you know what, maybe you've gotten a little too aggressive because the stock market has done well for really since COVID. I mean, COVID was the sharpest drop in stock market history. But leading into COVID, we had a nice run, and then coming out of COVID, we had a nice run as well. And it's just natural to get comfortable. Now, 2022 was a wake-up call for a lot of folks, and if you're fearful that something like 2022 happening again could cause you to change your asset allocation, could cause you to panic, could cause you to have some mental angst where you can't sleep at night, there's nothing wrong with that. It's important to recognize that and have it reflected in your asset allocation. So just as I said, nobody knows really what happened recently that caused the market to go down. While that may be true, you probably have a really good feel on when you want to retire. If you're interested in planning for retirement, if you're interested in thinking through what would be the best time for you to retire, that's why I made this video up here, why retiring at 65 might be a big mistake. Thanks for watching this one, and I'll see you in the next video. Bye-bye.